So what we're going to talk about today is bond yields. Starting from there, I'm going to look at 4 different ways that we might assess where yields might go. Obviously, we've had this strong bear market in recent months. US yields have increased quite a bit. The last couple of weeks, they've fallen back a bit. But where will they go from here? So I'm going to look at 4 different ways. It might be slightly geekish, some of the stuff I'll go through, but I'll try and do it slowly and try to make the conclusions very clear. Obviously, one of the big factors for bond yields is what will happen for inflation. And so I'll go on to talk about why we think we're going to see higher inflation over the next 2 or 3 years. But I'll give you the bottom line now, which is that we think the 10-year US Treasury yield is headed for the 2 to 3% range over the next couple of years, but I'll explain why. And then I'll talk about the implication for other bond markets, also for stock markets. Jerry will talk about currencies, and James will say a few words about structured products and what the implications are there. Okay, so deep breath and let's dive into it. The first way I want to try to understand where 10-year yield on US Treasuries may go is to look at the yield curve. And this chart is showing the blue line is the US 10-year yield minus the Fed funds rate, so essentially the yield curve. The red bars are US recessions. So I think you can see there's a pattern there. At the beginning of the economic cycle, right after the recession, the yield curve tends to be steep. And that's because the Fed is keeping official interest rates, the Fed funds rate, very low, while bond yields are higher. And then during the cycle, what tends to happen is the federal funds rate is raised by the Federal Reserve, first of all to a kind of neutral level. I'll talk about that a bit more later. And then eventually the Fed raises rates, so it's very restrictive. And at that point, the yield curve becomes inverted. So we see the minus figures there, as we saw indeed in 2019. So if we look at where we are now, the yield curve is only at about 1.3% currently, whereas historically, usually at the beginning, in the first couple of years of the cycle, it's more like 3 to 3.5%. So this is one reason why or if you like, one way of thinking about where yields should go, and it suggests the answer is 3 to 3.5%. Let me give you another way of thinking about it. If we think about where the federal funds rate may go when it gets to a neutral level over the next few years, and then add a spread to that, because normally you'd expect bond yields to be higher than the Fed funds rate. Somebody lending for a long period would expect a higher rate than if it's a short-term interest rate. What do we mean by the neutral Fed funds rate? This is the rate which is neither a stimulus nor a restraint to the economy. So right now, obviously, Fed funds rate is near zero. That's intended to stimulate the economy. We don't exactly know where the neutral Fed funds rate is. It used to be thought to be around 4 or 5%. That was the level typically thought of in the 90s, in the early 2000s, even back in 2010-11. Now the Fed reckons it's only 2.5%, about 2% for the inflation, which is the target inflation rate, and then quite a small real rate of 0.5%. That seems fairly reasonable to me. Then if you add a spread on top of that, and historically the spread has been between 0 and 1.5%, so you get to a bond yield implied of 2.5 to 4%. And let me show you another chart. I'm trying to illustrate that. So the green line here is the federal funds rate, again with the cycles shown. The red line is the spread of bond yields over the Fed funds rate. Now remember, we're looking for the neutral interest rate. I don't know if you can see my cursor here. I'm looking now in the sort of early 2000s period. Obviously, the neutral rate wasn't at the beginning of the cycle when rates were down at 1%, and it wasn't at the top of the cycle when rates were about 5.25%. It was somewhere in the middle when rates were 2, 3, 4%. And so what I'm doing then is looking down to see what the spread at that time was, and you can see it's somewhere around 0.5% to 2%. And I did the same looking at previous cycles in the 1990s, and again most recently. So this, again, I'm just going through what I just went through, essentially, the yield implied is somewhere between 2.5% and 4%. Okay, the third way of thinking about where the yield should go is to look at the link to the nominal GDP growth rate. So this is real GDP plus inflation. And if you look at this chart, you can see, roughly speaking, they go in line. Obviously, there are significant differences, but roughly speaking, they go together. And that's not surprising, because what you're really looking at is the yield against inflation. You'll notice in the 60s and 70s, the nominal GDP growth rate tended to be higher than the bond yield. And that's really because in those days, people didn't realize how bad inflation was going to turn out. They kept thinking it would come down quickly, and it didn't. So the bond yield lagged behind the nominal GDP growth rate. And then in the 80s, the reverse happened. After the really bad inflation experience of the 70s, bond markets said, no, we're not going to be burned twice. We're going to keep yields high. We're not convinced inflation's coming down, but in fact it did. So 10-year yields were above the nominal growth rate for some time. And if you look at the most recent period, you can see we've been there again with this time we've got the 10-year yield running around 2.5%, and nominal GDP running around 4 to 4.5%. So there's the 0.5 to 2% spread I mentioned before. So there's some theoretical backing for this. I won't go into that. There's some disputes over it, but there is some theoretical backing for the idea that the yield should be linked to nominal GDP growth. As I said with the chart, the relationship is not tight. What we've seen in the last 10 years or so is that bond yields have been about 2 percentage points below the nominal GDP growth rate. Okay, so where does that get us then? If nominal GDP growth is 4 to 5%, once we get out of COVID, then that implies a bond yield of 2 to 3%. So that's where I come out on this way of looking at bond yields, 2 to 3%. The final way to look at it is to look at where bonds traded in the last cycle. And this chart is a rather simpler chart, just showing where the 10-year yield has been over the last 10 years or so. And pre-COVID, as you can see, it basically cycled in the 1.5 to 3% range. And we're just at the bottom of that right now, just about 1.5%. So that suggests the yield, if it repeats what happened in the last cycle, should move up to about the 1.5 to 3% range. So I've got 4 ways to think about this, 4 approaches. Here they are summarized. The spread at the start of the cycle, the spread over the neutral Fed fund rate, the link to nominal GDP, where it traded last cycle. I guess if this was an intelligence test for 10-year-olds, we'd be able to conclude the answer is 3%, because it's the only number that carries over to all 4. I was a little bit more cautious, so I've concluded 2 to 3% based on the kind of weight of results here. So 2 to 3% is the bottom line for where we think the 10-year yield should go. So you might ask, anticipating the question, why haven't we gone there already? After all, we're talking about the 10-year yield. Markets usually anticipate. So why haven't we got there already, if I'm right? Well, I think there's still uncertainties over COVID and the general outlook. We've got the massive central bank buying still. ECB is continuing with it. US still doing it, as confirmed recently. In Japan, they have yield curve control, holding down short rates. And to some extent, international bond markets, if yields are held low elsewhere, that tends to hold down US yields as well. Then the Fed is seen as very dovish, not expected to raise rates for a long time. And I'll talk a bit more about that in a moment. These factors, I think, will likely dissipate over the next year or two. Hopefully, we'll get more certainty over the outlook. Hopefully, we will be able to largely leave COVID behind, at least next year. The central bank buying will be scaled back at some point. And I think the Fed at some point will start to sound less dovish. It won't be raising rates for a while, that's true, but it will start to taper its bond purchases. But obviously, much is going to depend on inflation here. And I want to go on and talk perhaps more briefly about why we think inflation will come back. First reason is activity, we think economic activity will bounce back very quickly. We have a massive fiscal stimulus in the US. President Biden has added to it and still plans to add more. And obviously we have easy money, we have the low federal funds rate, we have the quantitative easing. The Fed sees full employment by the end of next year. We think it could even be earlier than that. This is very different to the last economic cycle. In the last economic cycle, it took about 8 years to get unemployment back down to where it started. 8 years. This time, it'll probably take 2 to 2.5 years. So a much faster bounce back that we're expecting, and indeed the Fed is expecting. Another reason for inflation is the sharp rise in money supply. And in fact, it's been unprecedented what's happened over the last year. US M2 money supply over 25% increase. We've seen nothing like that over the last 60 years. Now, I'm not a monetarist, not many people are these days, and there isn't a simple relationship here. Nevertheless, it does raise eyebrows when you see money growing like this. If even some of that is spent, that will lead to very rapid growth, and potentially it'll feed straight through into prices. The dovish central banks, as I've mentioned, obviously it makes sense to be dovish right now in the middle of the pandemic. But the Fed has also announced a new approach to how it manages monetary policy. Now it's aiming for an average inflation rate, not simply going for 2%. So it has stated explicitly it won't raise interest rates until the US reaches full employment. And that's different from the past, when they tended to try to preempt potential inflation. As soon as unemployment was coming down towards full employment, they'd start to raise rates. But now they're saying they won't do that. And instead, they'll wait until inflation is above 2%. And they're happy for it to be above 2% for some time before they'll move. So this is a much more dovish approach than before. The fiscal stimulus I've already talked about. This is a chart from our latest quarterly showing the fiscal support. You can see massive amount of spending, particularly in the US, elsewhere as well. This includes the latest package passed by Congress, but it doesn't include the most recent infrastructure announcement that hasn't come through. And there's another one still to come, which needs to go through Congress. High government debt. The effect of COVID has been to push debt up by about 20-25 percentage points of GDP. High government debt gives an incentive for the government, indeed the Fed, to keep interest rates lower to avoid creating too much strain on the budget. I should mention there's also a lot of debt in other areas in the corporate sector as well. So again, it suggests you don't want to raise interest rates all that much. The danger then is that the Fed is very cautious, and that allows inflation to accelerate. And finally, a couple of long-term structural changes. One is the retreat of globalization. I think you can make the case that inflation has been held down pretty well over the last 20 years or so by the entrance really of China and China's huge workforce into the global economy. And one could add Eastern Europe, one could add the NAFTA agreement, which brought Mexico into the US trade arrangements. All these factors tending to hold down prices. Now, globalization is not dead, but it is retreating. Chinese wages are higher now anyway. A lot of companies are looking at shortening supply chains. I suspect that means that the downward pressure from globalization on prices, on inflation, may be over. Another factor is we're seeing aging populations, and this is really kicking in the 2020s in the West and in China too. There's some debate as to what impact that has on inflation, but I'm in the camp that thinks it is inflationary, for the simple reason that you're going to have fewer producers and more consumers. Older people still want to consume, still want their pensions, and indeed they're politically very powerful and will demand those. So you've got fewer people actually working. That tends to mean higher inflation. So this brings us to the sort of bigger question, the very long-term question of whether the bond bull market is over. This chart shows the US, UK, and Germany going right back to the 60s. You see the rise in bond yields from the early 60s, peaking around 1980, and then a long time coming down to where we are now, quite low levels. My view is the bond bull market is likely over. I'm not sure how rapidly it will reverse with bond yields trending up, but I think we've seen the lows and we'll be going sideways or upwards from here. What does it mean for other countries' bond yields? Again, this chart just shows the same one, but as previously, but for a shorter time period. So you can see that while the yields don't go exactly together, they do tend to go in the same direction at any given time. So the most recent rise in US yields was accompanied by rising yields in Germany and the UK as well. And that's no accident. So I think as US yields go up, we will tend to see the other yields go up as well. Possibly not as much, but certainly go up. So here's our bottom line. This was done a few days ago, so we're actually 1.5, I think, most recently for the US now. But you can see the 2.2 to 3% is our expectation for US yields, 1 to 2% for UK, and above 0 for Germany, pushing up towards 1%. Just wanted to speak briefly about what this means for stock markets. There's a lot of numbers on this table, but if you just go along the top, 1983 to 4. What I'm showing here is periods where bond yields rose in the US. So 1983 to 4, there was an 18-month period where the 10-year yield rose from 10.3 to 13.6. That's 330 basis points. And then in the yellow, you can see what happened to stock markets. So during that period, stock markets were up a bit. And when yields peaked, they then rose quite a lot. And altogether, there's 11 periods here where bond yields have risen significantly. You can see, looking down that first column in yellow, that every time stocks were still up, every time during the rise in yields. I think there's a good reason for that, which is that rising bond yields implies the economy is doing well and profits should be rising. So why wouldn't stocks rise too? If you look at the second column in yellow, what happens to stocks in the 12 months after the peak, you can see it's also true that stocks still continue to rise in most cases. A couple of big exceptions. 1987 was one of them. There was, of course, a crash in 1987, which took stocks down 30%. By 12 months later, they were only down 10%, but they were still down. And again in 1999, 12 months later, stocks were down. That was the beginning of the bursting of the first tech bubble. Both those occasions, 1987 and 1999, were quite late in the economic cycle. They were periods where the Fed was really tightening, really anxious about inflation. We're not there at the moment. So I think one should look at the rise in bond yields as not particularly threatening to stocks. People talk about this, commentators talk about it, but I don't think it's particularly threatening to stocks. Okay, I'm now going to pass on to Jerry to talk about currencies.
Yeah, hi, thanks, John. And as John mentioned, we expect the U.S. bond yield to trend higher and the other bond yields to follow along, but maybe just not as high or with the same amount of momentum. There's some opportunities for the spread that currently has U.S. 10-year note yields significantly above, for example, in the chart here, German Bund yields. That could remain the case, and it could actually widen a bit further. On this chart, you can see that the yield spread is the red line, and the way we did this was Bund yields minus U.S. bond yields, so you can compare it to the euro dollar. So if the red line goes down, that means that the U.S. bond yield is higher than the German Bund yield and is getting higher, or the spread is widening. Right now, it's around negative 130 basis points, and it has, during the previous 3 years, back down in 2018, we were actually below 250 basis or negative 250 basis points, which is a considerable spread between the dollar bond and the euro bond, or in this case, German Bund yield. So what do we expect to happen now? Well, we don't expect the spread to turn higher or significantly higher anytime soon. So therefore, we would tend to think that the dollar will continue to pay you to hold it. Now, bond spreads are only a small part of what makes up an FX market analysis or currency moves, but it does pay now and then to pay attention to, how do you get paid in FX? If the euro dollar is going nowhere, then holding euros will cost you effectively. And if you can get paid significantly more for holding dollar bonds, then there is a natural flow, or at least in the short term, to hold the dollar and pick up the yield. So what we're looking for is potentially for the euro dollar to drop towards 116. And there is some risk that we see 112, 110 again. And we realize that we're going against almost every single major bank and investment house who are looking for the euro to head a lot higher and for the dollar to drop a lot during the cycle, which is fine. We would consider resistance to be at 123, 125. Those would be kind of our pain thresholds for the near term. And then 130, 132, and 140 in terms of levels to watch for. But in general, we would say that John is right. The U.S. economy is doing very well. Inflation is a risk. Bond yields are probably going to go higher in the States. And the other guys will be dragged along, in our view, on the FX side, which should continue to support the dollar against the euro. John, can we see the next slide, please? This is sterling. Now, this is sterling against the euro, which we all look at in different ways. But for the purposes of this chart, it's we're looking at number of euros per pound. So if the blue line goes up, the pound is getting stronger. If the blue line goes down, the pound is getting weaker. In the red line, this time it's UK yields less German Bund yields. So if the red line goes up, that means that the UK gilt is yielding a lot more than the German Bund. And you can see there is some sort of connection between these charts in general. It's got a bit more of a lag because there's, like I said, there's a lot more than just bond yields in play here when you come to FX analysis. But for the most part, we would think that this is seeing the tug of war within a range between the gilt yield and the Bund yield. Now, to be blunt, I think it's going to be a bit of a roll of the dice as to which yield goes up higher first. You're kind of thinking the UK one will, which means that there's going to be some natural drag on the cross to go higher. But it's constrained by this 120 area for the moment. So as long as the 120 area holds as a ceiling, then we're looking for a range trade between 120 and 110, maybe 112, which for FX hedgers is fine. They know what range to play and what to do with the limits of the range. John, can we see the next chart, please? And this is cable, or sterling against the dollar. And here again, we're looking at UK yields less US yields. So you can see that the spread, which is in red, is just around 30 basis points now. Sorry, 60 basis points, around there, which is where it should be. Sorry, negative 60 basis points. I got there in the end. Yes. So as the red line goes down, then the blue line may be dragged lower if the yield spread favors the US dollar, right? Because cable is traded in dollars per sterling. So if the blue line goes down, that would mean that the dollar is getting firmer and sterling is slipping. Now, the consensus here is that, one, we had Brexit, so the uncertainty has been lifted, but it was a skinny trade deal, so there's not a heck of a lot of impetus to take us back to 150. But let's keep in mind, sterling is really, really cheap here in terms of a long-term historical perspective. We were trading above 211 just, 13 years ago? 14 years ago? So it's one of those things where you're looking at cable below 150 and you're thinking, this is kind of cheap. But then you look at the relationship with the bond yields and you're saying it's cheap for a reason. There's some pressure still on the UK. So what's our outlook? Our outlook is, one, if the yield spread stays within this range, then we could just see sterling throttle around between 126 and 144 for the next year, which is a fairly broad range, but it is what we have been doing for a while now. If for some reason the UK yield actually firms up a bit and we see the red line tick higher, then we could see sterling start to bounce above 144 and heading towards 150 and maybe even higher, which I think would be interesting for a lot of sterling hedgers. The real risk is the US continues to see higher yields and the UK yield is constrained by, let's say, the 1% area, and you see the red line drop a lot further, and that could drag cable or sterling down towards 126 and maybe down towards 120. We don't think that's a huge high probability event, but that's probably where the risk is in terms of market thinking. Thanks, John.
Okay, over to James.
Thank you, John.
James, you yep.
I'm not muted anymore. Okay, thank you, John. Just to recap for everyone, what I understood from from both John and Jerry so far is that we are looking for U.S. bond yield going up to 2 to 3%. Inflation is going to go quite high in the U.S. It probably drag also the rising bond yield U.S. is going to drag other bond yields up. So a question mark is there whether we are seeing the end of the bull market in bonds. The other takeaway seems to be that little table that John did about the equity market performance in the days that bond yields are rising. It seems that actually historically that the equity markets are doing relatively well during the bond yield rise and after 12 months after the bond yield hit a peak. So maybe the concerns of equities being hit by rising bond yield may not be happening. So that's another thing. So stock market may be doing better than expected, whereas the bond market may be something that people need to be cautious about. And then we heard about Jerry about currency, about dollar being stronger. And for us who are in the UK, looks like sterling is going to trade in a very wide range. So I think there's some takeaways there from different asset classes for different investors. Now, from a background of being a structured product and derivatives guy, I've been asked to talk briefly about structured products. So that's why I'm going to spend a few minutes on about that. For those who have been or the first time heard about structured product, it's basically similar to a bond, except the returns are linked to an equity, typically equity market indices or different stocks. So that is what we call a structured product here. And usually, structured products pricing are affected by the two things, actually three factors there. So these three factors are the interest rate, the funding needs of the issuing banks. Usually banks issue these bonds as structured notes, and people will hold them in the portfolio, or in the UK, be sold to retail investors using structured product plans. The funding needs also affect the pricing. Last point is volatility, and I'll touch on that. The importance of volatility is not only on the pricing of structured products in the next few months, but also in likely performance of existing products. So first look quickly at rates. So John, next slide, please. You've seen this chart already because we have looked at it a while, probably a few slides back. This is the 10-year bond yield for US, UK, and Germany. As John pointed out, it has recovered and is rising after the low we saw last year. But look at this. Even the US, which is a little bit above the pack, you can see my cursor here. There's an orange line there. It's still below what it is in 2015, and also even just after the financial crisis. Similarly for UK and Germany. Now, the usually rising interest rate will help terms of structured product. It actually improve the product terms. But the moment is probably going to not to be doing this because even the rate have risen, it's still below what we've seen last 10 years. So that is one thing that we have to consider. Rates have risen, it probably will improve product terms, but the rates are still below what we have seen before the pandemic. So next slide, please. John. Thank you. The other thing we talk about will be looking at the funding needs. This is what they call the credit default swap. It is basically a measure, a derivative measure on how much banks will be charged when they typically give funding. When the bank is structured product, they need to give the structured product desk a funding, how much spread they're going to take above the bond yield that they were willing to take the money on their balance sheet. During the financial crisis and straight afterwards, banks all need money, And we see even though bond yield goes down, funding spread goes up. As you can see in this here, this is JP Morgan, courtesy of CNBC website. You can see it goes up a lot here. This is during the pandemic last year, but it goes even higher during the financial crisis. We didn't have the data so far back, but that was even higher. Some banks even have a CDS of about nearly 1,000 basis point at a point. So when the bank needs the money, they're more generous, and again, that improves the product terms. So at the moment, however, you can see now it's gone down, partly because of stimulus and partly because actually the funding needs is actually not that much now from the banks. You see the money supply is already quite high, so the banks are not going to give that spread anymore, and you do not pick up those product terms as expected. So that's the second factor. Shall we look at the next factor, please, John? Shall we look at the next slide, which is volatility? Now, this is interesting. These are two volatility indexes. The left is the S&P 500 index volatility, and the right Euro Stoxx 50. Basically, if we actually do structured products that have what we call soft protection or barrier feature, which means that if the index or indices does not drop below a certain level at maturity, your money will be returned in full. That's what we call soft protection. And usually, when volatility is high, the product terms of such structured products, typically income products or auto call or kick-out products, will improve. As you can see, there's a very brief period last year. There's a spike here, even though it's still below what we saw during the financial crisis. But then it dropped rapidly. Now, that it also means that some of these product terms will not be as good as before. But more importantly, this drop in volatility is supported by the rally in equity market over the last 12 months. So you can see the title here, I call fearless. Usually these volatility indexes measure fear. At the moment, the market is not very fearful. They're not that concerned about what's going on in the about the inflation, etc., less than the bond market. So equity market is likely to be supported because of the good sentiment, and it probably will improve some performance of existing structured products when they actually get to maturity or reach dates of auto call. So to conclude, next slide, please. Rising bond yield may not make headline rates higher, and volatility could stay low in US, UK, Europe if stock market continue to be strong. As we said previously, even during a period of rising bond yield, stock markets tend to perform quite well. There's something called worst-off strategies. I'm not going to give you details here. For those who actually know, they basically link the performance of structured products to certain 2 or 3 underlying assets, and you base the performance based on the worst performing one. We use that quite a lot, structured products people over the last decade, to enhance headline rate. Because volatility and rates and also the funding needs are not that supported in pricing, we expect that to continue. There'll be a lot of still these worst-off strategies out there, but it may help the pricing, but it may not be as much as the 2010s, because at the moment, a lot of underlying indices move in tandem because of the general bull market we have been seeing. Because of strong performance in stock market, we expect more kick-out and early maturities than 2020. So it's good news for some structured product providers, advisors, or investors to get early results and they can reinvest their money. I think this is one thing I kept saying, is that we need and we expect more innovation because of the pricing pressure and the need for investor in this market. Because although bond yield is rising, people still need the income, and so they would need alternative underlying assets, use of different stocks, different stock basket, different type of indices, and using even link the performance to interest rate itself, which we've seen about a decade or so ago in the 90s, which is quite, and 2000, which is quite popular. So that's the implication for structured products from me. Until next time, thanks for everyone to attend.